Thank you to you all, and it's a great pleasure to be here in Holland, even if in the last 24 hours or so, as fog settled over the North Sea, one was slightly hesitant about one's chances of actually getting here, but I am here and very glad to be here with you tonight. I'm particularly glad not to be stranded at London City Airport, which I can promise you is not the nicest places to spend a foggy day. When people outside the financial sector ask me questions about finance, they often begin by phrasing a question something like, so what do the people in the City of London actually do? And the answer I have to give is that to an extent that almost defies the imagination, what they do is they trade with each other. Let me give you one or two examples to reinforce the point. We all know how much global trade in goods and services has grown over the years since the Second World War. But today, global trade in foreign exchange is about 100 times the volume of global trade in goods and services that underpins it. For every real transaction, there are 100 times that volume of market transactions. Today, a lot of people in Britain still think that what banks do is they take money from savers and they lend it to business. And when I explain to them that lending to non-financial business accounts for less than 3% of the total assets of British banks, they are quite surprised. Indeed, so are quite a lot of bankers when I tell them that. But actually more than 70% of the assets of UK banks are accounted for by the liabilities of other banks and vice versa. And those of you who've read Michael Lewis's, well, it's now his last but one book, because there's another one about behavioral economics that I've written a rather abrasive review of in the last week or two. But if you've read Flash Boys, you may be familiar with the fact that a company called Spread Networks has recently built a telecoms link through the Appalachian Mountains. The purpose of the link is to reduce the time it takes to transmit data between Chicago and New York from 7.3 milliseconds to 6.6 milliseconds. And just to give you an idea, a millisecond is a shorter time than it takes you to blink, and the irreducible minimum to that distance between Chicago and New York is the time it takes light to travel from Chicago to New York, which is 4.3 milliseconds. We haven't quite got there yet, but we're getting pretty much towards it. And when I explain this to people outside the financial sector, the next question that they ask is, so what is all this for? And at that moment I pause, because it's not immediately easy to come up with a good answer to that question. What I'm going to describe in the start of what I say tonight is this process of financialization, which has occurred over the last 40 years, in which the financial sector has grown. You will see, particularly grown in the United Kingdom and the United States. The financial sector has grown significantly in share of GDP, and of course, not just in the numbers of people employed in it, but in the amounts that people who are employed in it are actually paid. It's a world in which banking has changed from what it used to be, which was like that. You can see the archetypal old-style banker, J.P. Morgan, up in the top right. The Wells Fargo pony train, which is how the bank began transporting bullion across the United States, in the bottom left-hand corner, and in the two other corners, what banks used to be like. More recently, they look like this. This is a sign which was sold in 2008 by the liquidator in London of Lehman Brothers for what is reported to have been a rather large sum. I've tried to find out where it actually now is, so far without success, but I imagine it's a trophy that someone holds somewhere. And you will see our soon-to-be Prime Minister, Gordon Brown. I would like to pay tribute to the contribution you and your company make to the prosperity of Britain. This is Gordon himself opening the plaque. When I was a schoolboy in Edinburgh in the 1960s, joining the Bank of Scotland or the Royal Bank of Scotland was a career for the boys in my class who weren't going to get quite good enough grades to go on to good universities. And they would join the bank or the Royal Bank, and they would expect to spend their entire working careers in it and retire in due course with a pension. By the time they had expected to retire in 2008, when the Bank of Scotland and the Royal Bank of Scotland went bust and were bailed out by the British government, the bank was run by much cleverer people with MBAs from the best business schools, but people who were not quite as clever as they thought, or clever enough to manage the environment in which they had created and in which they were now operating. And they rang the bank not just worse, but much worse than their very much less intelligent predecessor. That's what has happened in these parts of the financial sector. And it's had effects not just on the banks themselves, but on the wider economy. This is the story of the incidence of financial instability in Western economies. And you can see a pretty clear pattern in which from the Industrial Revolution, from the beginning of the 19th century, you get a gradual increase in the incidence of financial instability. That accelerates in the first part of the 20th century. It reaches a peak in the great crash of the 1929, early 1930s, and then we get this long period of extraordinary financial stability. From the start of the age of financialization, which I've been describing, you see the incidence of instability increasing again until, of course, we see at the end the global financial crisis of 2008. So the effects of financial instability on the wider economy once grew, was stabilized, and then accelerated again. You can see a similar impact in terms of the much discussed question of inequality and the share of the top 1%. And you will see in that across the world, the share in total incomes of the 1% decreased across most of the 20th century until the 1970s. In the 1970s, in France and Germany, it stabilized, it flattened out. In the UK and US particularly, it increased until by today, the share of the top 1% in total incomes is higher in the United States than it was a century ago. So the process of financialization has effects that extend well beyond the financial sector itself. But what I'm going to talk about today is the financial sector itself and one part of that financial sector, because I'm going to focus on capital allocation and equity markets. Well, it should be clear that modern economies need a financial sector. Indeed, the whole process of the Industrial Revolution is very much bound up with the development of financial innovation in the 17th and 18th century, financialization which incidentally very largely took place in Britain and the Netherlands at that particular time. And we need a financial sector today basically to do, in my view, four things. The first is the fundamental utility of the financial sector, which is operating the payment system. The way we receive wages and salaries, the way we pay our bills, the way businesses transact with each other. And that is actually what most of the people who work in the financial sector are employed in doing. Most people who work in the financial sector are actually not masters of the universe earning telephone number salaries. When I looked at the remuneration structure of Barclays Bank, I discovered that if the top 1% of people in Britain earn about 14% of total income, the top 1% of people who work for Barclays Bank earn more than 40% of the total remuneration of people who work in Barclays Bank. And a majority of those who work in that bank actually earn less than the British median wage. That is, most people who do these jobs are doing mundane clerical jobs in bank branches and bank back offices. We need the payment system, and without a functioning payment system, both economic activity and social life would quite quickly run to a halt. Secondly, we need a financial system to help us with wealth management. Now, the term wealth management has become appropriated for providing rather expensive services to high net worth individuals. But what I mean by wealth management is the wider job of enabling us to fund education when we're young, house purchase as we develop households and families, and to finance our retirement and to provide for our children if we want to provide for our children. That's the business of wealth management, and it's a large part of the retail financial services sector. The two boxes at the bottom of this slide are what the wholesale financial services sector typically engages in, which are risk mitigation and, capital allocation. And if I ask people in the City of London to justify what it is they do, they will talk in large part about financial innovation over the decades of financialization as having helped with risk mitigation. Instead of talking to people in the city, I talk to people in the street and ask them, do you think that financial innovation over the last 40 years has made your life more or less stable and secure? They would probably look at me as if I were some kind of lunatic. But let's pass that by for a moment. I could give a long lecture on risk mitigation. I'm going to give part of it to some students in this university tomorrow morning. But the one I think I ought to talk about tonight is what concerns most of the people in this room, which is capital allocation. When Lloyd Blankfein of Goldman Sachs gave a rather ill-advised interview to the Financial Times in 2009, he explained that what Goldman Sachs were doing was God's work. When the interviewer asked him what the deity had in mind when he'd selected Goldman Sachs for this particular task, Blankfein went on to explain that what Goldman Sachs did was they issued securities in order to enable companies to invest. Companies then, he said, invested, they created wealth, and by creating wealth, they enabled people to save more, subscribe for further securities issued by Goldman Sachs, and so on. It was, he said, a virtuous circle. There were several fallacies in that argument, one of which was that securities issuance was an important part of what Goldman Sachs did. Over the last decade, issuance has accounted for less than 10% of Goldman Sachs revenues, and the bulk of these revenues actually come from trading profits in secondary markets. The second and more fundamental mistake, which we'll come back to, is to think that issuing securities was the way in which the kind of companies that are Goldman clients actually raised funds for fresh investment. It's not, as we'll see. Let's turn to the question of how capital allocation actually works in a modern economy. If we want to look at capital allocation, we need to ask what the capital of economies actually is. And this is a breakdown of the capital stock for the 4 countries which I've taken as exemplars of modern economic development: Britain, the United States, France, and Germany. And you can see that what the capital stock of a modern economy is today is predominantly housing. In France and in Britain, housing today accounts for about 60% of the total physical assets of the country. It's slightly less in Germany, where it's about half, slightly under half in the United States, but in all 4 countries, housing is the largest element of capital employed. The rest divides roughly equally, it varies a bit across countries, between 3 major categories. One is non-residential property. The second is other structures, which basically means infrastructure of various kinds: road, railways, telephone lines, electricity grids, and the like. And finally, the other element is plant and machinery actually used in business. That's what the total of capital stock actually is today. It's predominantly housing, with these 3 other significant categories. Now, what we have in terms of physical assets is, of course, necessarily matched by what we have in terms of household wealth. And household wealth looks broadly like that. If I take these 4 countries, you'll discover, as you're almost bound to discover, that the total value of physical assets and the total value of household wealth is pretty much the same. Although we talk about global capital markets, actually net flows are extremely small relative to gross flows. If I take the case of the UK, which is perhaps the most extreme, it's when I looked at the end of 2012, which is where this data comes from, Britain's total overseas assets were £10.49 trillion. It's quite a big number. And Britain's overseas liabilities were £10.63 trillion. So the net item is incredibly small relative to the total. In all of these 4 countries, and in all major developed economies, basically physical capital matches household wealth. And this is what housing wealth is, what household wealth is. You'll see that just as physical assets are dominated by housing, so household wealth is dominated by housing. Housing wealth is obviously a smaller proportion of the total because we have to net off mortgages. But in Britain, even after I net off mortgages, housing, net equity in housing accounts for about 40% of total national wealth. It's a similar figure in Germany and in France, quite a bit less in the United States. You'll also notice that the United States is the only country in which savings, securities held by individuals are a significant part of the total. We'll come back to the implications of that in a moment. You will also see that Germany stands out because Germans are obsessive in their interest in cash and deposits, and Americans equally stand out because of their relative lack of interest in cash and deposits. The differences in the structure of household wealth are a bit larger than the difference in physical assets, but nevertheless, the structure of this in modern economies is pretty much the same for all of these. So the first thing we have to recognize is that in a modern economy, capital allocation is principally about housing. And the truth is, when the second tier of bright boys in my class in Edinburgh went off to join the Bank of Scotland and the Royal Bank of Scotland, the boys were not quite clever enough to get jobs with the Royal Bank of Scotland, went to join savings institutions, which we called building societies, which were the ones that lent out money on mortgages to people to buy houses. And there's a close analogy with what happened in the banks. They actually managed the process of mortgage lending a good deal better than their successors, who were under the mantra of Lou Ranieri, the Salomon Brothers trader who in the 1980s invented the mortgage-backed security and famously said, mortgages are math. Mortgages are not actually math. Mortgages are about finding people who are reliable buyers of houses who are willing to pay the money back which they've borrowed to buy the housing in the first place. But the capital allocation side of things, which we're really primarily concerned with tonight, is not housing. There are two broad channels of capital allocation that take savings and translate them into physical capital. One, which is the one these people in building societies, thrifts, other specialist institutions concerned with housing finance manage. Today that has mostly been subsumed into the banking sector. But what we're concerned with there is taking the deposit channel and funneling that into essentially the mortgage business. The second part of capital allocation is taking these long-term savings and channeling them into the other parts of our national capital stock, which are infrastructure, commercial property, and business investment. And we need tonight to particularly focus on business investment. We need to think about the way in which capital needs of business have actually changed. The equity markets with which we're all familiar came into being in the 19th century. And they came into being in the first instance to finance railways and railroads. Now, railways are very capital-intensive businesses. More than that, they're specialist capital-intensive businesses. If you build a railway line, there is not very much you can do with it except run trains on it. And that model and these savings to finance these capital-intensive activities were collected in fairly small penny packets from middlingly well-off people in the 19th century, and stock markets then served the role of providing a degree of liquidity for the railway stocks and the railway bonds that people bought in order to finance these investments. And that model of financing was then extended to the manufacturing corporations that came to dominate the industrial landscape in the 20th century. It was the petrochemical plants in the top right-hand corner, the automobile manufacturers, Ford and General Motors in the bottom left, companies like General Electric with a wide range of manufacturing activities. These were the great corporations of the 20th century. But the great corporations today of the 21st century are not quite like that. The two companies with the largest market capitalization today are Apple and Alphabet, which is the parent company of Google. These are both companies, it varies from day to day, but their market capitalization is of the order of $500 to $600 billion. But the tangible assets, the operating assets of each of these two companies is between $20 and $30 billion, less than 5% of the total. Both these companies have huge piles of cash, which reflects the profitability of the business and the anomalies of the US tax system, but operating assets are a tiny proportion of the total. The assets they own, they're not capital-intensive businesses by their very nature, and such assets as they do own don't need to be owned by the company because in large part they're offices and retail premises that are fungible. They don't need to be owned by the company, and they typically aren't. Apple's flagship European store, which is in Regent Street in London, is jointly owned by the Queen of England and the Sovereign Wealth Fund of Norway, which is an indication of where power in global capital markets actually really lies in large part today. In any event, it's not owned by Apple, and it doesn't need to be owned by Apple, and Apple is doing very well all the same. So that we have this changing structure, this change in the nature of companies. which means they're not capital intensive. Capital isn't typically owned by the business concerned. And to the extent that a company which is large enough to be listed uses capital for investment, it typically generates more than enough cash from its internal operations to fund investment. So ExxonMobil, which of large companies in the world today is the one that most looks like these traditional businesses, and is by far the largest investor of any private Western company in the world, although it does have very substantial tangible capital assets. Actually, the amount of the value of the shares ExxonMobil holds in treasury as a result of share buybacks it's undertaken with its surplus cash, that value is actually larger than the total value of ExxonMobil's physical assets, its refineries, its stations, its oil reserves. So that large business today is not, in this sense, capital raising. When I did the review of equity markets described in the introduction, I discovered that if I looked at the amounts raised on UK equity markets over the previous 2 decades, the figure was not positive, but negative. The amount which had been taken out of the market in share buybacks and in acquisitions for cash was actually greater than the amount which had been raised from new issues in rights issues and IPOs. When companies come to list in London, apart from a variety of Eastern European companies that I would rather wish didn't, they typically do so not in order to raise fresh capital for investment, but in order to provide a liquidity event for early-stage investors. Stock market today is not a means of putting money into companies, it's actually a means of taking it out. That's not an unimportant role, but it's a very different role from the role that markets played back in the 20th century. The second big development that's happened is that, as I was describing earlier, when money was raised to fund railways, it was raised directly from private individuals. That isn't true anymore. As we've seen in an earlier slide, most savings are today institutionalized. Now, if I'd been talking even 20 years ago, I would have said most savings are managed by pension funds and large insurance companies. But these asset holders have increasingly either outsourced their investment management or divested their investment management activities, with the result that the people who dominate the investment scene today are asset managers. These are who they are. And all of these asset managers today, with assets in excess of $1 trillion, are larger than, well, there's one pension fund, the Japanese public pension fund, which is larger than the smallest of these top 10 asset managers, but it's the only one. The next largest fund in the world is the Norwegian Sovereign Wealth Fund, part owner of that Apple store, which is just under $1 trillion. And then we come to the large pension funds below that, Kalpers, ABP here in the Netherlands, and then after that some British funds. So that the dominant players in equity investment today are these asset managers. And this, to my mind, fundamentally changes the nature of the capital markets we have. Two things have brought about these changes. The first is that the change in the nature of companies changes the needs of business for capital allocation. I've explained the way in which established business, the kind of businesses that have historically been large enough to qualify for listing, no longer need depend in any way on capital markets for their funding. That means that stewardship, the management of existing assets, is not just a byproduct of equity investment, it is today the main function of equity investment. The capital allocation process today in the business sector largely takes place not through markets at all, but through an internal process of allocation within companies themselves. And to look at a company like Alphabet, the parent of Google, which we were looking at a moment ago, that is today, I sometimes think of it as a cross between an incubator and Berkshire Hathaway. It's a company that is building, essentially, a portfolio of innovative businesses in its sector. The future of equity markets, then, as far as this sector is concerned, is going to look very different from the one we've been used to in the 20th century, in which we could say of these petrochemical plants, automobile plants, that the shareholders own the plant and the workers come to work every day in that plant. Today, because these are knowledge-based businesses whose value actually rests in the team of people who work there and in the brands they've generated, they're by their nature partnerships between the company and the people whose money is invested in it. And that means the relationship between the company and the shareholder has to be very different from the one we've been used to historically. It means that engagement, understanding of what the company does, is not actually any more a nice thing to have. Governance and engagement are actually the central part of the deal. And if that's true, it draws one's attention to a paradox. Because if everything I've been saying the last 10 minutes has been to say that the need for capital markets of the type we saw in the 19th and 20th century has diminished, at the same time we've seen an explosion of the volume of secondary market trading in these markets. And that's in a way an extreme example of the way in which our finance sector has become self-referential, trading with itself, talking to itself, and unconcerned with the needs of the real economy. Where that takes me to is a belief that the future for these kind of institutions lies not in ever more frenetic pursuit of alpha by hectic trading in public markets, but by developing real and substantive engagement in the activities, governance, and strategies of the places where the underlying funds are being invested. And that requires a significantly different skill set from the one which these fund managers have been used to over the last few decades. Now, in order to bring that change about, I think we need a change in the expectations of asset holders. We need a change in the way asset managers view the nature of their businesses. And we also need changes in the nature of regulation. Because at the same time as I've been describing as the need for this kind of activity in secondary markets has diminished, we've institutionalized the need for these secondary markets through our regulatory processes. That all the things we've done, the mantra of liquidity, that it's enough in any regulatory debate to mention the word liquidity, and you know that if you're saying what you do might conceivably damage liquidity, then you've in effect put an end to the argument. The truth is, we already have orders of magnitude more liquidity in financial markets than are needed to meet the underlying needs of the beneficiaries of capital market activity. We don't need liquidity in this sense. We don't need the ability of institutional fund managers to be able to realize a very high proportion of the value of their investments within a few days. We don't need to know every day what the value of these activities actually is. I think markets would be served well enough in terms of the needs of the underlying beneficiaries if we'd stock markets opened once a month, far less at high-frequency trading, in which a millisecond is a long time in the life, well, not of a high-frequency trader, but of the computers that actually do the high-frequency trading. We have, I think, in this sense, far more liquidity than we need, and a regulatory model which is essentially ossifying a structure of capital markets in the financial services sector, which was a product of the 19th and 20th century. I find it difficult to give talks like this to a general audience without them wanting to say at the end, what we need, of course, is more regulation of the financial sector. I don't think we need more regulation of the financial sector. I think, as I've been suggesting, not only do we have regulation that is part of the problem rather than the solution, I think we actually have far more regulation than we need. When I hear people talk about deregulation as being the cause of the problem, I show them this, which is only one example of a set of slides which I have demonstrating what has actually happened to the volume of financial services regulation over this era of financialization. Actually, what has happened has been we have replaced the old culturally driven self-regulation of the financial sector by an increasingly burdensome rule book. Thank you all very much.